Gentle readers, welcome to Everything is Everything. I'm Amit, and this is my good friend Ajay. And some of you might have noticed that a couple of weeks back we released this great episode of The Seen and the Unseen, which was all about Ajay Shah's life and times. Because you've done a bunch of episodes with me on The Seen and the Unseen, but never a comprehensive life and times. And that was 10.5 hours, and it's an awesome episode. I absolutely love it. And various people have gotten in touch to say that that 10.5 hour episode was too short. They were like, hey, you didn't cover this, so you could have covered that, and etc. etc. And one of the topics that we touched upon there, but we couldn't cover in full because we were running out of time, because hey, how much can you do in 10 hours, was the journey of Indian finance, which is a chapter that you wrote for the Cambridge Economic History of Modern South Asia, which is a compendium volume being brought out. It's edited by Latika Chaudhary, Tirthankar Roy, and Anand Swami. And in the past, they didn't have a chapter on finance in previous volumes. But over here, finally, they decided finance is the lifeblood of everything. Who better to us than Ajay Shah? And you've written what is almost a magisterial account of the journey that Indian finance has taken right from 47 to now. So, we're doing this episode to kind of go over that territory because it's so fascinating that, let's leave a form of it in video as well. And what I was also struck by, and which underscores a theme that you have been on, is that the journey to change is a long journey. The journey to change always involves playing a long game, thinking over the long term. Change, there's that famous saying about how paradigms change one funeral at a time. And similarly, true change takes decades. So when you look at the arc, it seems almost glacial. But you have not just known the history, you've lived some of that history in your 30 years in this field. So yeah, the journey of finance. Thank you, Ajay Shah, for doing this.
And gentle reader, I want to point you to the Everything is Everything episode on the long road to change. And in addition to all the gloomy things you said, change is not certain, change is not permanent. If you don't babysit a reform, it will go away.
And I also want to add, since you're referring to old Everything is Everything episodes as well, our episode 21, The Beauty of Finance, which I thought was a masterclass in just understanding why does finance exist? How did it come about? What are the circumstances that made it come up? And most crucially, why is it so critically important to the functioning of the real world? It's not a bunch of rich people playing in an online casino. Finance impacts every aspect of our lives. And so I'm really looking forward to the next hour. So, Ajay, our story starts in 1947, and in the first chapter, you're going to talk about banking. Now, give me a sense of, how did the overall intellectual climate of those days affect what happened to banking? Because, as we know, those were days where it appeared from a distance before we knew the truth that, hey, the Soviet Union was doing well, that model was working, America had just come through the Great Depression and were coming out of it with a massive involvement of the state. So, it was natural for people at that time to think that the state has to control everything, especially in a poor country. You can't allow the rapacious forces of the market to take charge. And Nehru once famously said to J.R.D. Tata, do not speak to me of profit, it is a dirty word. So there was a distrust of markets, which we can look back in hindsight and say it was completely illogical, it was BS, they didn't understand the positive sumness of things. But tell me a little bit about that mahal and how that affected their thinking towards banking.
Yes, we have to always locate the ideas in a time axis in the historical context. That's the best way to understand the world. You have to see that there had been many banks that had emerged in India, both by the British and by Indian entrepreneurs, and there had been many bank failures in India. Okay, so there are serious economists who dream of free banking, and particularly I feel in the modern world, the institutional possibilities for free banking are much greater. Free banking is completely unregulated banking, and I am interested and sympathetic in those kinds of ideas. Okay, so I don't want to diss the ideas. But at the early stages, banking really sucked. That banking was a disaster prone 19th century industry. That's a quote from Merton Miller. That banks just kept blowing up, and many banks in India kept blowing up. In 1934, when the RBI Act was done, it was centered around monetary policy. Okay, so you remember when we talked about inflation targeting, I talked about the preamble of the RBI Act, where in 1934 the British say that in the present state of disorganization of the international monetary system, it is not possible to determine what is an appropriate monetary arrangement for India. So, as a temporary measure, we create the Reserve Bank of India. At the time, the thought was just about rupees and silver and bimetallic standards, and that's all. They were not thinking of banking. The sense of the problems of banking regulation really came later, that one by one many banks failed. And look, this also has to do with global economic conditions. So, as you correctly said, the Great Depression was a catastrophe. About a quarter of the balance sheet of the banks of the United States blew up. So just think, one quarter of your banking system goes bankrupt, and that would have large global repercussions, because by that time the United States was the greatest economy of the world, and the Great Depression very much rapidly showed up in India. And through all those dark years, so in a way, British rule in India is one part, a relatively successful part, from 1757 till 1913. And then when the First World War started, just many things started going wrong. You had the First World War, you had the Great Depression, you had the Second World War, and the British project in India really went very badly wrong in many respects, because they were facing questions about the survival of the empire and the survival of the UK. Operation Sea Lion may have worked. It was the invasion of the island by Nazi Germany. So people actually designed an invasion of the UK in that period. So in those times, many things went bad in India also. So in India, there was economic distress, and the global trade collapse, the global GDP collapse of the Great Depression adversely affected India, and so many banks went bust. Okay, so there's a great R.K. Lakshman novel which I read as a child, which is really my first beginning in starting to think about a run on a bank. A run on a bank is a brutal thing. The bank is a trusted, well-respected entity, deeply integrated into its own social community. And then one fine day, people start getting nervous and saying, will I get my money back? And they think of going to the bank and getting their money back, and suddenly a queue forms. And once a queue forms of 5 people, it becomes 500 people in no time. And then it is in the nature of banks that they will blow up, because there's no way a bank can serve 500 borrowers all at the same time. So there were huge problems in this period of bad macroeconomics in the Indian banking system. And this led up to a call for change, and the Banking Regulation Act was passed, and also the first bank nationalization began. So the old British Imperial Bank was taken over by the government, and it was turned into the SBI. So well before Indira Gandhi was dreaming bank nationalization, these kinds of things were already afoot. And you correctly located this in the discussions around the Soviet Union and the uh, attraction in the eyes of the Indian elite about the Soviet model. You will be amused to know that way back in 1848, there was a radical pamphlet called the Communist Manifesto, which was full of scurrilous ideas, and one of their scurrilous ideas was centralization of credit in the hands of the state by means of a national bank with state capital and an exclusive monopoly. Okay, so this stuff matters. Okay, some academic scribbler in the years gone by shapes the madmen in frenzy, and 1848 is a long time ago, but lo and behold, after independence, these ideas gathered momentum, and people were very comfortable with the idea that there will be a government monopoly, there will be centralization of credit, and the government will control the credit, it will direct the credit. All these things were just that age. And after 1989, we look at everything in the Communist Manifesto with more skepticism, but a large part of that has not yet been reversed, meaning there's quite an agenda in store for the world to reverse everything that is there in the Communist Manifesto.
So I have an aside and 2 points to make. And my aside is that the ideas of someone like Marx, the ideas in the Communist Manifesto, manifestly wrong as they are and dangerous as they are, and despite the havoc they caused in the 20th century, will always resonate more with people than ideas of freedom propounded by the likes of Hayek and Milton Friedman and so on, our heroes. And the reason for that is that Marx's ideas actually speak to our instinctive sense that things can be planned from the top down, that the world is zero sum, that you need a strong man of the tribe who will decide everything, etc., etc. This that software speaks to our hardware, as it were, already naturally. And as we know, some of our hardware is dangerous. We need to mitigate it with other software. And also, some of these instincts which evolved in prehistoric times are wrong. We have a great episode on classic economic fallacies which people make, and all of which people make because they're hardwired to make them. Think of the world in zero-sum ways, not understand spontaneous order, etc., etc. Anyway, that's an aside, but that is why people who care about individual freedom and liberty and understand the value of it will have to fight anew in every generation, eternal vigilance, as it were. The two side points I have, and one is really minor, but the way in which the term free banking is kind of used by people in the field is not just banks that are not regulated, but banks often free to issue their own currency. And this might seem utterly anarchic, but as the great Lawrence White, a friend of mine, a great economist and an expert in this field, if not the pioneer of this field, showed that there were decades in various parts of the world that this was done, and this actually worked. It wasn't chaos, it wasn't everyone going mad. And some say the ideas behind cryptocurrency and all that came out of Lawrence's work, so do check out my Seen and the Unseen episode with him. And the second point I want to make is also a clarification about how banks shutting down all the time is not a bad thing. It is a natural way of things. We did a great episode after SVB shut down, where you and Mohit Satyanand joined me on the Seen and the Unseen, and we chatted about that. And this is an important point that you made there, that if people imagine that no bank should ever shut down, we should, stop it. No, in the natural order of things, just as many firms open up and they try different things, some of them fail, some of them succeed. The ones who succeed show a new way to the others, and the world gets better in that way. It's kind of the same thing in finance. So can you expound on that a bit? Because people might think of that as a little counterintuitive.
Okay, we've got a whole chapter planned ahead on bankruptcy, where I will do both financial firms and non-financial firms, and let's come to it there. So
let's continue your narrative.
Okay, so after independence, we got to first the government's control of SBI, and then 1969 a bigger sweep of bank nationalization, and then 1980 a further extension of bank nationalization. And it was a world where there was a central planning system and the government called all the shots. So were you allowed to build a steel mill? What kind of technology could you use in a steel mill? Could you import machines for the steel mill? Could you import raw materials for the steel mill? All these were controlled by the government. And then once you went to Delhi and got all those approvals, then you came to Bombay and waived those approvals in front of a bureaucracy. And the bureaucracy will say, hey, yeah, you got the industrial license. It's a license to make money, and we'll give you the credit. So it was really just one big central planning system. It was an extended central planning system. Gentle reader, central planning is the land where the design of products and processes emerges from officials and politicians, and not from the freewheeling, anarchic, confusing, competitive process of the people. Okay, that's central planning. If a government is getting a say on products and processes, that's called central planning. So we just emerged into a completely choked banking system where everything was controlled by the government. It just turned into a form of taxation, that who could run a bank? The government would not give permissions for private people and foreign people to run banks. What could the banks do? That was completely controlled by the government. Who would get credit from the banks? That was part of that cozy, tidy central planning system. So it was just one big, the words resource mobilization are shamelessly used in that period, that yeah, we're going to take money from the households and we'll give it to our chosen ones. They were unembarrassed about saying these kinds of things. That's the logic of socialism, that the government controls everything. The government will decide, shall there be a steel mill? Who will be the person who builds a steel mill? All this is coming out of the government. Okay, so banking just became a handmaiden of the government. Now, it is inevitable that when you build a centrally planned system, it will fail in many respects. Okay, so many things will start going wrong, and every now and then a gap was discovered in the working of the world. And the worldview at that time was not that there is a gap, there are people, there are customers who need to be served in certain ways, and there is that freewheeling, innovative market process where the people will discover new ideas for products and processes. No, instead you are given a central planning system, and when a gap is seen, we'll create a brand new PSU for that. So they created a new PSU called IDBI, they created a new PSU called ICICI, they created a new PSU called HDFC, and so on, one by one. When gaps in the system arose that were not being served by the existing central planning system, the solution was not innovation, entrepreneurship, risk taking, 100 business models will experiment, 95 will go bankrupt. No, no, no. The government will decide. Now you need housing finance, as if you had never needed housing finance before. And we will create one monopoly called HDFC, as if any one monopoly can possibly serve the richness and complexity of this country. And in all this, there was very little regulatory capacity. So the word regulation really is about a private person, that there's a private person and they're doing some things and there is market failure in this world and you might seek to address that. That whole capability, that whole concept was not there. It was just central planning. We're all hand in gloves. So there is a Ministry of Finance, there is an RBI. They don't actually know how to think in significantly different ways. So in the episode on inflation targeting, I commented about how primitive economics was. The monetary economics knowledge in India was just abysmal. I mean, I've read a whole bunch of that stuff, and I've also had the privilege of having conversations with a lot of the players going back to a time when I was a tender young soul. And I really know how those people thought, and their knowledge of economics was just awful. And that same kind of thing happened in banking. Their knowledge of economics was awful. And they just viewed this whole thing as one happy family. We have banks that are controlled by the government. The Reserve Bank of India puts a board member on the bank. And the regulation is really central planning. We're telling everybody how to operate. Isn't that our job? We are the central planner. So just like there was a planning commission in Delhi that would play a role along with the Ministry of Industry and the Ministry of Steel on controlling what a steel factory would do, the RBI became the central planning shop of the financial sector, and it became their job to prescribe every detail of products, processes, technology, everything. So here is a amusing late stage story of that genre. In the early 90s, computers happened. So RBI decided that we need computers. Computerization is very good. And there was a Rangarajan committee which wrote down what computerization has to be done by all the banks. Okay, and they decided that there will be this ABCD kind of automation. They chose the name of the CPU. They chose the name of the disk controller which will be inside every bank. So you could literally take the RBI report and it became the IT strategy of every bank. And they were unabashed or unembarrassed about doing this because they thought that's their job. That's how it works. So Rangarajan committee specified some SMD disk controller. So the whole Indian banking system moved to SMD. So a technological choice was made by officials, which is a complete red line. No government officials should ever get into picking winners. That's like a recipe for trouble in the working of the economy. But this is how that operated. So Indian banking basically just turned into one central planning system where there was a Ministry of Finance which owned banks. There was a Reserve Bank of India that wrote hundreds of pages of regulation about how banks worked, and they used the coercive power of the state to block private banks, to block foreign banks, and they instructed all banks on what to do. All banks looked alike and they did the same things. There was no innovation, there was no product development, they were just bureaucracies. And in fact, the centralization of senior level appointments of all the PSU banks just underlines that it's a bureaucracy. So you would rise up the hierarchy in one bank, and then there would be a centralized recruitment process whereby an executive director of one bank would become the MD of another PSU bank. It was all one little super bank controlled by RBI.
So I have a question about this period. You know, when people talk of Indira Gandhi, they often talk about the horrors of the emergency, and I agree that they were horrible and they threatened our democracy, etc., etc. But I think what was equally bad was a lot of the economic package, the economic policies that she brought out. I think there were crimes on humanity. They, perpetuated our poverty. In fact, she said "Garibi hatao," but essentially they kept hundreds of millions of people in poverty for decades longer than would otherwise have been the case. And one of the, one part of the puzzle, one of the many things that she got wrong was bank nationalization. Now, most people, when they talk about bank nationalization, and people in that party will still support it, though they wouldn't have 15 years ago, but now they've kind of swung back, and they'll, still support it. We'll talk about the intentions that you want to make banking accessible to rural markets and, lend to the poor, which would otherwise not happen, etc., etc., etc. And I love the fact that you used the word taxation, that it was like a kind of taxation. I have earlier said that every interference in free markets is like a redistribution of wealth from the poor to the rich. And that's exactly what I see happening here, except it's not even a redistribution of wealth from the poor to the rich, it's a burning up of notional wealth. So, elaborate a little bit on that for people who are listening to this and they're saying, what's wrong with bank nationalization? There are greedy capitalists, they don't lend to poor people, etc., etc. They don't go to villages. So bank nationalization to theek hai, but the intention is seen, the outcome is unseen. So tell me a little bit about the counterfactual, that what world did not come into place because all this was happening.
There are some people who have a vision of banks as simple, trivial, dumb organizations where you're supposed to take in deposits and give out loans. And there are people who feel this is trivial. And I wish to say, please, no, this is not trivial. This is a very complex activity. For hundreds of years, many banks have experimented and innovated and tried many things and gone bankrupt. So this is far from simple. So now you're back to the basic tension of socialism, that when you run things through a bureaucracy, it just goes dead. So you get the silence of a graveyard. It appears to work in some ways, and I'm going to describe ways in which it does not work. But most importantly, it just doesn't think. There is no brain there. There is a lack of innovation, there is a lack of risk taking. And to reach into the vast length and breadth of India across 10 deciles of income class, you need many different kinds of business models. You can't say I have one size fits all. When you have one size fits all, it's basically for the top decile. So in fact, you are harming the interests of 90% of India when we build a bureaucracy that is a banking system. And one of the best counterpoints to that attachment for socialism that is so prevalent in Indian finance is the journey of Indian telecom. That look at Indian telecom. There was a government monopoly, there was a Department of Telecommunications, and there was an MTNL, there was a BSNL, and there was a VSNL, and it was all tidy. The government is there, no? They will give you telephones. What is wrong with that? And then they will also say national security, the government has to be able to tap your phones. How can a private guy run a telephone system? And we watched how for years and years and years, basically it just did not work. So the Indian rich got telephones after waiting for 10 years or after paying bribes, and most of India got no telephones. So the bottom line is there was no telephony for India. And the breakthrough moments are where this sector was opened up by people like Sudhendra Kulkarni and Arun Shuri working in the Vajpayee government. And the private and foreign entry came into this field. And now suddenly the most advanced exotic technology, mobile phones, which was once 16 rupees a minute, turned into a Janta product, which is everywhere in India. In the old pre-liberalization India, the aspiration of the government used to be that there would be a village telephone scheme where they were going to put one pay phone in every village, not where you throw a 50 paisa coin and you make one call and you don't get long distance. That was the dream of the telecom policy in the olden days. One payphone per village. And today we've gone to a place where there are something like 1.1 billion telephones for 1.4 billion people in India. That is the power of what the private sector can do. The private sector will innovate, the private sector will harness technology, the private sector will do new things, the private sector will make mistakes, the private sector will have firms that go bankrupt. And that is the energy of how we make a market economy work. We missed out on all that energy because of turning banking into a bureaucracy. It is exactly as dead as telecom as a bureaucracy, or steel as a bureaucracy, or what have you.
And people will often look back in the late 1980s, and for some reason, this is a narrative that has emerged that, hey, Sam Pitroda made the telecom revolution happen. This is rubbish. He was into technology, but there was a very central planning view of it, and there were just big, rich elites playing around with toys. What made the telephone revolution happen was markets. The technology would have happened over time anyway. What made it was exactly those reforms you pointed to during the Vajpayee era, when a telephone call went from 16 rupees a minute. Even incoming calls would cost money at one point, I remember, to something much less. And I love your illustration of telephony as a sector where it changed. I often talk of telephony and airlines. Like airlines were so incredibly expensive. I was a son of an IS officer, pretty elite kid, but I hardly ever took a flight. It was expensive, even for us, way beyond our means. And telephones again, can you imagine a waiting list for a telephone being 7 years, 8 years? That used to be the case in those times. Tell me about the reform years. Like 91 changed everything is one simplistic narrative. As you and I know, it didn't change everything. There were some reforms in some areas. Tell me about the story of banking from that period.
So at a strategic level, by the early 90s, RBI had woken up and understood that there is such a thing called banking regulation, and that we don't know anything about banking regulation. Okay, and it helped that in 1995 there was a big mess in Indian Bank, and it was discovered that there was a 5,500 crore NPA hole inside Indian Bank, and it was a big crisis. And then they started thinking that, oh, there's a thing called prudential regulation of banks, and the first attempts started being made on learning how to do financial regulation. Okay, very weak, incomplete steps. Even today, banking regulation barely works, but that was the first idea, that it is not just a central planning system, it is actually supposed to be about regulation. And you started getting two wings of thought in RBI. And so, if you want to think of two groups inside RBI, you would anthropomorphize them as one guy saying that we need a banking regulator and we need to develop regulatory capabilities at RBI, and the other saying, Nana, we're just doing central planning and we're fine. So there are these two strands in that world, and the regulatory thinking began. What does banking regulation constitute? At heart, it's just two things. A bank has given out a loan. How do you know its accurate value? So you don't have to wait till it becomes NPA. You want to understand on a moment to moment basis that is there a problem here, and then I should accept a mark to market loss. So imagine I gave a loan of 100. Now there was a material deterioration in the riskiness of that borrower. So play a hypothetical scenario that if I auctioned off that loan into the public, what would the public pay me for that loan given facts about the borrower known today? Imagine that's 80. Then I should price it at 80 and I should take that 20 rupees loss now. Now the bank will not like to do it by themselves, so you use state power to create the rules whereby the banks are supposed to do this. Until today it hasn't happened. There is just all kinds of confused stuff that is done by RBI, but this is the heart of what needs to be done, that you need to market all the assets of a bank to today's fair value, discovered in a variety of ways. For example, one approach could be that the government forces all banks to take a small random sample of their assets and auction them off into the market and look for deviations between the internally supplied value of the asset versus what the market was willing to bear. So that becomes a measure of the haircut of the discount that has to be applied on the claims of the bank, and that can be used for banking regulation. So these kinds of things can be done. We can debate, there are many ways to do this stuff, but at heart you got to go after this. But on the other hand, this will bring out all the bad news. You will know that banks are bad, you will know that banks are in trouble. And in a central planning system, RBI is mother. Mother cannot allow bad news to be told to the public. Mother is part of the hiding of bad news and standing up and making a brave front that we will keep all the problems inside the house, but in front of the world we will say banks are great. Okay, so there is this inner battle for the soul of RBI that has played out with largely poor outcomes in the succeeding years, but this is the kind of problem that happens. The second thing that needs to be done in banking regulation is that banks have to have a certain amount of equity capital. That if you're going to take deposits from the public, which is borrowing from the public, then you also need your own equity capital, which is the buffer to absorb losses. So I'm going to make up numbers. Imagine that you have 95 rupees of deposits, 95 rupees of borrowing from the public, and you have 5 rupees of equity capital, which is how Indian banking works. What that means is you have the ability to absorb 5 rupees of losses. That on the 95, if you make mistakes and you lose 5, you've got the loss absorption capability, because your equity guys are being told there are no guarantees, I am not going to repay you your money, and if things go bad, you'll lose your equity capital. It's limited liability, but you stand to lose your money. But if the loss is 6 rupees, then you're bankrupt. So you got to ask yourself that is a 5 to 100 equity capital ratio wise and appropriate for Indian banking? And I believe the answer is no. Okay, both because of the extremely high macroeconomic uncertainty of India, plus the low capabilities of banking regulation at RBI, like I just described, around the problems of valuation, it just makes sense to be prudent and have way more equity capital to protect against bank failure. So these kinds of things have not been thought through and understood. So what happened was that a couple of private banks came through. It's a very interesting and sad puzzle that by and large, family run banks, promoter run banks have failed. Eh, Maybe one or two exceptions, but generally, when there was a family business that was a bank, this 595 tension was too much. You're putting down 5, then you're taking 95 from the public, you're giving out loans of 100. It is too easy to give out loans of 100 and take bribes of 10, because I put in 5, I take bribes of 10, and I'm basically making a ton of money while giving out lots of bad loans. So that seems to have been a rough story, which partly is about ownership and governance. So you need to think a lot about firms and their board of directors and their governance. But equally, it's about failures of regulation. That I don't say that family businesses are bad. I say that the regulation failed, that the regulation created this 595 situation. And the regulation did not create that valuation mechanism whereby you would ensure that the assets of the bank are valued correctly. Okay, so I'm not here to ascribe blame. I'm just describing a statistical regularity. And the way I would put it is the Indian state failed to create the incentive package under which private people gave birth to healthy banks. But a bunch of banks that were created from a more financial institution pedigree, these tended to work better. So you had an ICICI bank which came out of ICICI. We had an HDFC bank that came out of HDFC. These kinds of orgs worked reasonably well. There was a handful of those. So very successful entry by a few private banks, and more power to them. They've worked well, but like too little and too few. A remarkable feature of this period is that basically there are no bank licenses and there are no new banks. So for all practical purposes, there's a very high entry barrier and it's hard to create new banks. Another remarkable phenomenon is that there are no foreign banks. It's like, I don't know, I don't understand in what universe it makes sense to not have foreign players in Indian banking. Okay, the foreigners make phones and cell phones in India. The foreigners make ice cream and sell ice cream in India. The foreigners make shirts and sell shirts in India. Why are we blocking foreigners from operating banks in India? If anything, this has gone in reverse, that the operating environment in India has become so hostile that some important players have chosen to give up on India and leave, for example, Citibank. This just makes no sense. So the energy is in private and foreign, and really it hasn't come. And like we are stuck, that there is low state capability, there is low intellectual capacity. So when private banks have come, very often they've blown up. And so we've settled into this low level equilibrium that basically it's a lot of public sector banks, it is some private banks, and it's a full central planning system. The energy, the agency of competitive, sophisticated banks hasn't really arisen. And we are stuck in a trap with a malfunctioning Indian banking system. In all this, again and again, banks have failed. Banks have failed all the time. And again, I blame banking regulation, that it is banking regulation that has not created the correct incentives for the managers of banks to do the right things. And roughly speaking, from 1992 till today, about 5% of 1 year's Indian GDP has gone as government money to the public sector banks, which you could readily interpret as an underpricing of credit by the banks. So the banks are giving out loans at rates that are too low because they're not recovering enough cash flow to pay for their bad assets. And this has just been going on forever. It just year after year, it keeps happening. Every time there's an economic downturn, there is a banking crisis.
And this is effectively a transfer of wealth from the poor.
From the taxpayer to the mismanagers of the banks. So all in all, the Indian banking story is just disappointing that this hasn't worked. Our good friend Harshvardhan and I have a profound disagreement, and we have these heartbreaking, difficult conversations around two views of the world. Harsh says that banking is fundamental to the emergence of a successful capitalism. Okay, and I get that, and there's nothing I would want more than a successful banking system. But I also see the dysfunction around banking regulation and bank resolution. We're going to come back to bank resolution. Bank resolution is a fancy word for what are you going to do with the bank once it blows up. Okay, so there is dysfunction in banking regulation, there is dysfunction in banking regulation. And then you really need to ask yourself tough, hard questions that, is it wise and appropriate to grow a large banking system in a country where the commensurate state capability is absent? So is it wise and appropriate to dream that in 25 years we can build the knowledge and the community through which banking regulation and bank resolution will be done successfully in India? And after that, you want to grow a banking system? Or do you want to take the risks of lurching from bank failure to bank failure and all the adherent misery and the adrenaline rush of socialism that happens around each of these? So every time a bank fails, you get a fresh wave of socialism. You get, we hate the rich people, we want to put up an LOC at the border to grab Vijay Mallya. All those toxic things happen out of each wave of bank failure. So that has its own consequences, and it has been my view that if we are a third world country and we don't know how to run air traffic control, then maybe you should not have so much air travel. And that sounds like a very anti-development thing to do. But if a crazy amount of planes are crashing all the time, then you need to think more about what is the growth strategy, what is the development strategy for the country. So Harsh totally disagrees with me, and my views break his heart and his views break my heart. And I don't want to suggest either is right, but I just want to put up this debate for discussion that given how poorly we have fared in the last 25 years on developing regulatory capacity in banking and in bank regulation and in bank resolution, what is an appropriate strategy going forward? I would like to find non-banking ways to make progress. So can you do more through the bond market? Can you do more through NBFCs? Can you have more debt venture funds? Can you have more foreigners? Can you have foreign banks operating in India, unregulated in India? Okay, let a foreign regulator regulate the bank in India. Let a foreign resolution corporation cover the death of a bank in India. Look for every end run that can avoid solving this black box, because we've spent 25 years and failed, or we've spent 35 years and failed. And it's hard to tell a reasonable story that it will take less than 25 years to learn how to do banking regulation and bank resolution.
I have an episode on banking with Harshvardhan here, so you can check out his views in some detail. Fine man, both of you have a good heart, so they should not be broken. You and I both agree one thing about the Indian state in a broader context, which is that instead of doing many things badly, it should do a few things well. Now, the few things that it should do well are things like law and order, defense, etc., and that it doesn't do well at all. And instead, it does many things badly, which includes intrusive things which keep players out of the market and have the unseen effect of effectively taxing the poor. Is that a good summation also of the state of banking regulation in India? That, yeah, you need regulation, but there are limited things it should do really well. Instead, it doesn't do those things well, and its tentacles are spread far and wide, and it's avoiding that beautiful market process, competition, etc.
That is indeed correct. And at the end of our conversation today, that's basically the kind of universal themes that I'm going to pull together across all the 8 sectors. That at heart, it was an intellectual failure of the Indian elite to build a knowledge and community around words like market failure, central planning, rule of law, state capability. Okay, these are the 4 pillars of how you can think about all these things. But because we did not have this intellectual firepower, we just had a bunch of confused things, and we always went on doing central planning. We were negligent about rule of law. We were devoid of public choice theory. So we were always willing to give the benefit of the doubt that, oh, bank regulators are good people now, so we give them wide powers to do whatever they want, and there is a lack of check and balance, there is a lack of transparency. So in short, all these failures fit under 4 headings of understanding central planning and staying away from central planning, understanding market failure and actually doing something about market failure, while recognizing limitations of state capability and creating the checks and balances, so that in a skeptical public choice theory way of the world, those government organizations will actually deliver some performance and not just turn into unaccountable power.
And earlier you spoke about those, 2 entities within the RBI. One is central planning, one wants regulation and understands markets and all of that. And it might seem at one surface level that the regulation guys won. But I think it's a central planning mindset only that dominates, where they're saying, okay, we won't plan everything, but we'll be in charge. We'll decide all the important things,
So for some years, it looked like there was intellectual capacity emerging in Indian finance, but by and large, you know, it didn't work out. Uh, we thought we were going somewhere, and instead, it has just retreated into more and more central planning.
So, Ajay, chapter 2, banking boring, equity markets exciting. Let's talk about equity markets and how they have evolved.
So, in the story of the equity market, India was the first stock market of Asia in 1874. You will recall there is an episode of EIE we have which has a title like Why Freedom Matters, which is actually an economic history of India, where I tell a story of the amazing days after the start of the Suez Canal. In 1869, the Suez Canal came, the telegraph came to Bombay, from London to Aden to Bombay, and the Companies Act came, the Contract Act came, all these amazing equipment of modern capitalism came to India. Alongside that, in 1874, the Bombay Stock Exchange came. And it worked in a small, quiet way in the early years. It was a critical part of the early emergence of Indian capitalism. But then, along with freedom from the British in 1947, there was a decline in the role of the private sector. So the equity market did not do a whole lot. Now, in all this, the Bombay Stock Exchange was led by a group of mostly Gujarati and Marwadi stockbrokers. It was a private association of persons. There was no government in its teeth. And they just didn't do a great job. That they weren't able to produce a robust, reliable payment system where you put in your money and on a completely predictable clock you should get shares, or you put in your shares on a completely predictable clock you should get money. They weren't able to do this. They just kept collapsing from crisis to crisis. And the second thing is that in every financial market trading system there is a problem of market manipulation, where some people acquire market power and they become the monopolist, coercing a market and generating a fake price and literally cheating people other than themselves, because those people see the false price or the false trading volume, and it entices them to act in ways which are really tantamount to fraud. So this is supposed to be the work of the exchange. The exchange is supposed to be the front line of enforcement against this kind of market manipulation. Now, the association of persons contained good actors and bad actors, and every market manipulator was hand in glove with some of the members. And unfortunately, this turned into a low level equilibrium where they would not enforce on themselves. And while this comes easily to the statist Indian mind, I have endlessly been troubled by that period, and I feel bad about that period. Why were these people not able to come together and find a Kosian bargain and do that negotiation between themselves? That, look, we got to get our act together. Modern technology has come. We can do the trading better. We can get a perfect settlement system. We can broaden out to traders and participants from all over India. And if we solve the problem of the market surveillance and the market manipulation, then we will reassure more people about participating in the market. So, see, when you have one firm making adulterated medicines and selling them in a shop, it is in the self-interest of the firm to do that, because that firm can just hide in the vast ocean of medicine sales in India, and they'll never know, nobody will ever know, and that firm will make an absurd level of profit because they're just making fake medicines. Here I'm not discussing one firm who is one bad actor. I'm discussing the entire community. There were some 300, 400 stockbrokers who were the AOP, the Association of Persons, who made up the Bombay Stock Exchange. And in an ideal world, they should have come together and negotiated with each other and found that Kosian bargain whereby they were able to build and modernize the exchange and make it much better as a private organization. And that would have been the best thing possible for India. And I'm very sad to say that didn't happen. And I feel that's an interesting and important question for all of us to wonder, that why did private action, why did private collaboration, why did private deal making not overcome this problem? Okay, but it didn't. And then the government stepped in, and there was a set of 3 new organizations that were created. That was the securities regulators, SEBI, that was built starting from 1988 by Surendra Dave, Ravi Narayan, Chitra Ramakrishna, a bunch of others. And then NSE, that was built by R.H. Patil and Ravi Narayan and Chitra Ramakrishna and others, starting from 1992. And NSDL, the stock depository, built by NSE and C.B. Bhave, from 1995 onwards. Okay, these three organizations came along and built a new world. And legalistically, NSE and NSDL were private organizations with 51% shareholding by uh, private persons, and SEBI was backed by the coercive power of the state. So there was a SEBI Act in 1992 which gave SEBI coercive power, and that coercive power plus a new exchange with a whole new set of concepts around how trading will be done and how governance will be done, how enforcement against market manipulation will be done, how computer technology will be used to open up to access from all over the country. This was quite a revolution, and it created a great equity market. This is one of the great success stories of the Indian reforms. It is on a par with the greatness of Major General Khanduri and the National Highway Authority of India, with the telecom reforms, okay, and a whole bunch of other great things that happened in India in that period. I think of the equity market as a hero of that story. I want to focus all of us on the things that made India great. Consider the software industry. Okay, for years and years, the banks were not going to lend to the software industry. First of all, at first, the software industry was highly risky. And then the banks would say, oh, but this is so risky, we can't do it. And further, the banks always wanted collateral based lending. You had to give me a factory as collateral. And the software companies just have, you know, buildings. So they have a very low capital intensity. And what are you going to put up as collateral? Because ideally you should be renting a premises, at most you have a building. But that's not enough. You can't pledge the building and get sufficient capital required to build a modern software company. So, starting from the Infosys IPO of 1994, I see a direct link between the emergence of NSE and SEBI and the funding pathways for all the new age capitalism that came about in India. And in this, one very important date is also 1992, when the liberalization for foreign investors started coming into India. So the foreign investors started coming into India and they just choked on the old BSE. In 1993, in August and September 1993, there was the first surge of foreign investment into India, like diddly tiny numbers, like $100 million a month. Okay, like nothing great, but like, oh boy, $100 million used to feel like a lot. And the entire settlement system of the BSE choked and collapsed. And the streets of Bombay were filled with truckloads of share certificates being transported from one place to another. And the BSE was not able to perform the settlement. And that's just not something that foreign investors were able to work with. And I also remember how NSDL was inaugurated on the 6th of November in 1996. There was a critical piece of enabling legislation that was required for it, a beautiful law called the Depositories Act that was drafted by P.J. Nayak and M. Sahu. And it needed to be passed in Parliament, and the government did not have a majority. And I remember a critical milestone where the British Chancellor of the Exchequer, the Finance Minister, met Manmohan Singh and brought this up, saying, this is a real choke point, you guys got to do it. And then Manmohan Singh bubbled up to the Congress political establishment that by hook or by crook, this law we've got to get through. And I don't know what means were applied, but they got that law through. And then the depository was launched. And one of the happiest days of my life is where we were at Nehru Center. There was an auditorium which was the inaugural of the NSDL. And I seem to remember on stage were C. Rangarajan, no, Bimal Jalan, the RBI governor, and D.R. Mehta, the SEBI chairman, C.B. Bhave, the MD of the depository, and P. Chidambaram. And I think somebody pressed one carriage return to pretend that a first transaction took place, and P. Chidambaram hugged C.B. Bhave, and that was the end of the ceremony. So the entire ceremony was 5 minutes.
It's so easy to make you happy. But, so this entire story, by the way, is related in at great length in our Seen Unseen episode together, 10.5 hours, and it is an inspiring story. And, you've used the phrase low-level equilibrium a few times during this conversation. So when I went to DC in July, I was hanging out with my friends Devika Kher and Piyush Tank. And together, I don't remember whose idea it was, but this phrase came up. So I proposed this quote for the show. And then there was a meetup of viewers of the show and listeners of Seen Unseen. And I told everyone this code. And the code is that every time I use the phrase low level equilibrium, what I actually mean is, and Namsita will have to beep this, but what I actually mean is, so every time I say it's a low equilibrium situation, I actually mean it's situation, right? So you've used that word many times, but I don't think that you will disagree with this, possible interpretation of the phrase either.
I use low level equilibrium like a great South American novelist, where everybody is good and pure and pursuing their self interest, but in the outcomes are just terrible. You're trapped in a horrible
Yeah,
world.
yeah. So it's a situation.
Situation.
The people are
And
not truthful.
exactly. So the agony is that the people are good and the people are pursuing their own incentives, and they all have an internal logic, and the outcome is just broken. That's just heartbreaking.
Anyway, so miracle story, but everything doesn't end happily ever after. So tell me about what's happened in the last decade or more that have everything's kind of gone off course.
So the equity market was the star pupil of the financial reforms, and it was built out of knowledge and community. So there were a whole bunch of people. There was an bureaucratic consensus and an institutional understanding at the Ministry of Finance, at SEBI, at NSE, and in some academic organizations about what the Indian financial system was and where it was going. And that entire team was disrupted, and we've thrown away that community, we've thrown away that team, and we're really back to a normal bumbling world of policy making, and then many things start going wrong. Interesting and important things get reversed. So we're just back to, we've been rolled back by a generation because we've lost the knowledge and we've lost the community.
Yeah, it's a very sad story. There is fraud, there is politics involved here, there is vendetta, there are allegations. We won't go into any of that now. Maybe someday we can do a long episode on everything that's happened. Ajay, what's next on the agenda?
So alongside the two big ones, banking and the equity market, there is a bunch of other financial firms that we need to also look at. I'd just like to briefly talk about mutual funds, insurance, and pensions. First, let me push pensions out because we've done plenty of material on pensions, most notably a show of Everything is Everything, where I think we've done a nice first principles treatment of the journey of pensions. So that's an example where there was knowledge and there was a community, and then it withered away. It was not actively disrupted, but it withered away, and nobody thought that the knowledge and the community is the actual theory of change. And so it just withered away out of inattention. And then, sure enough, over a couple of years, the pension reform got into deep trouble. In the case of mutual funds, by and large, the reform was pretty decent and I think is reasonably well done. Originally, we started out at a monopoly by the UTI. The Unit Trust of India was a government monopoly mutual fund. Then this was opened up to competition. Very vigorous competition came about. Large amount of private and foreign mutual funds have chosen to operate in India. UTI went through a crisis in 2000, 2001, through which they also lost market share significantly. And the share of UTI today is small. Also, after the UTI crisis, an amazing high quality reform was constructed at the Ministry of Finance in the world of Yashwant Sinha, Jaswant Singh, Bimal Jalan, and UK Sinha, where they applied a metaphor from the world of banking, which is called good bank, bad bank. So the overall UTI was cut into a good UTI and the bad UTI. The good UTI was sold off as a normal private mutual fund. I will say inadequately sold off, but still it stopped being a creature of act, and it did not come under the DFS as a under the Department of Financial Services like a normal PSU bank. And so the good UTI was put well on the path to becoming a genuine private organization, where it is about halfway there. It kind of froze halfway in, and the bad UTI was resolved in manual ways and by and large successfully. Okay, so the UTI story ended up reasonably well, and plenty of entry by private and foreign mutual funds has happened, and the mutual fund industry works reasonably well. There is one critical mistake in the mutual fund industry. This has to do with cross-border stuff. RBI and SEBI have choked the ability of mutual funds in India to invest overseas, which has a dramatic adverse impact on the quality of their portfolios. Okay, it's just a free lunch that you diversify globally, your risk comes down. It's a free lunch. Everybody should take it. Once again, the government is preventing the creation of high quality products that would serve the people of India appropriately. But that's a routine theme we see all across the Indian landscape. Finally, insurance. Not such a great story. There was a political logjam in getting through to the law that would create a insurance regulator and open up entry barriers for new insurance companies to come up. And this was the United Front government. Chidambaram was the finance minister, and they were not able to get a deal to get the law passed. Finally, Chandrababu Naidu made an bargain with Chidambaram that we will give you support for this law, but in return, you got to put the IRDA, the insurance regulator, into Hyderabad. Okay, now that's a bit of a pity because really the human capital of finance is Bombay. So whether you say gift city in Ahmedabad or IRDA in Hyderabad, these things don't work. Finally, the energy, the endless human networks, the quiet person to person transmissions of knowledge, information, and culture, these happen in Bombay. So Bombay is the seat of Indian finance, and you would not place the United States SEC with a significant operation outside New York. It just doesn't make any sense. So in similar fashion, it's a lukewarm experience with the IRDA in Hyderabad. Also, LIC stayed very big. The entry by private people was slow and halting. There are problems where there is an FDI restriction against foreigners coming into India and starting insurance companies. Um, there are very toxic practices in terms of consumer protection which have flourished in the world of insurance, and it just seems like an unusually bad sector in India. When I do talks about personal finance, I often say, like, be careful, be very skeptical about any insurance product being sold to you. There's just a lot of bad behavior going on by insurance companies. So my health check is mutual funds by and large reasonably well done, insurance mediocre, pensions major reversals. So that's like the rest of the financial system.
I agree with you about the absurdity of IRDA being in Hyderabad. It's kind of like if IPRA was in Karjat. You know IPRA?
No.
Indian Podcasting Regulatory Association. Surprised you don't know this.
No.
You should design it. What if there's a market failure in podcasting?
And there surely is.
It surely is. Then what happens? Ajay Shah, I want you to think about
Asymmetric
this.
information. What if a podcaster is taking positions on the shares that she is pushing? Have you considered that?
This should
Don't you think we need a regulation
they
to
should
block
certainly be regulated. Yeah, I mean, this is well done.
that?
So, Ajay, I often think of nation states as these artificial constructs which actually divide people and impede the flow of labor and capital to where they can be utilized best. Earlier, you spoke about how it would be lovely if foreign banks were allowed to set up and, compete with the best here, and we would also learn from that, and everything would be hunky dory. Tell me a bit about capital flows, because it's again, it is unseen to the normal person that what restricting capital flows actually does, because it's a counterfactual, we'll never know. But capital flows have been severely restricted all along, haven't they? So give me a sense of how that's evolved.
Yeah. In the good old days, in the first globalization, gentle reader, please go look at the EIE episode called The Third Globalization. In the first globalization, there were no capital controls. Anybody could take money anywhere in the world. And there were bond issues in London to build railways in India and so on. It was just a completely open world where you went to the best place to raise money, and that money was used at the best place where it could generate a return. And that was a good design of the world. Starting from Nazi Germany, you started getting capital controls, like so many other intrusions into human freedom. And most of us have normalized this so much we don't even think about it. But pause for a moment to think that, do you think that passport restrictions are a fair thing? Like, how can a government tell me that I can't leave the country without a passport? And I just want to say, how dare you? It's like, I'm a free person. How can you ask me and use coercive power to prevent me from leaving the country? Very well, in similar fashion, how can there be meaning to leaving a country, to being a Jewish refugee out of Germany, if you can't take your wealth with you? Imagine if a government says, you can leave, but your wealth is trapped. You're stuck here. And then that creates enormous disincentives. So if you think of the decisions of people every day to stay, to leave, to stay, to leave, which are perfectly legitimate, then it is a very unhappy environment when a government forces people that your money is blocked here, your wealth is blocked here, and then if you want to leave, you can leave, or maybe I will even block you from leaving. These are all unreasonable intrusions into human freedom, and they should be seen as fundamental human rights. But then let's go further, purely into the world of business. I already talked about raise money where it is the cheapest. It is so elementary. Okay, capital is the most important raw material that goes into a steel factory. People think that steel factories consume a raw material of iron ore and coal, but no. If you look at the cost structure per ton of steel, the highest cost is the cost of capital, and compared to that, the iron ore is a smaller number and the coal is a smaller number. So if you want to be an efficient, productive steel company, you want to access the cheapest capital from all over the world. Okay, think about risk sharing. Okay, the most efficient landlord where you should rent a house in that amazing tower of yours in Warsaw should be a foreigner. Why? Because their economic shocks are uncorrelated with your economic shocks. It makes no sense for the landlord and the tenant to both be exposed to the same shocks. Like imagine if the landlord lives in the same building. Okay, their wealth, their life is exposed to the fortunes of the same neighborhood, either economic success or a riot or whatever. Then you're just under diversified, you're taking too much risk, and that doesn't make sense. You get free reductions of risk by distancing all parties all across the world. So the dream of economics is that you, Amit Bhai, should own a flat in Tokyo that you rent to a Japanese guy, and that Japanese guy should own a flat in Warsaw that he rents to you. That is risk sharing. So each one is separating out their asset from their labor market income, and you get a better life for everybody. So these are just great free lunches. Now, unfortunately, nobody got the memo in India, and we just built up one of the world's worst systems of capital controls. Right in 1939, when the Second World War started, the British imposed a bunch of currency restrictions, and over the years they got worse and worse. In 1947, there was a Foreign Exchange Regulation Act, and in 1973, it was amended by Indira Gandhi to include criminal consequences. So the government controlled everything you could do cross-border, and if you dared to violate that, they could put you in jail. And then they created a horrible non-rule of law organization called the Enforcement Directorate to enforce this law. Okay, so this is just all the terrible stuff that happened there. And now you get to the failures of the 91 reforms, that they thought that they would improve the FERA by making a FEMA. Okay, so a new law was passed, the Foreign Exchange Management Act, not Foreign Exchange Regulation Act. So I don't know which word is more offensive.
I'd like a FIFA, Foreign Exchange Freedom Act.
Yeah, a Foreign Exchange Freedom Act. And that was done in 1999. But the knowledge and the community was not there. So it's a pretty awful draft. Right at the beginning, it says all transactions are banned. So unfreedom is the baseline. And then on top of that, we will give you some peephole freedom here and there as controlled by the great government, which is just wrong. It is not the way to think about public policy. And the economists were very happy, and they were tooting the idea that, oh, FEMA is so great, at least we have removed criminal clauses from the FERA. But when you protect that repressive apparatus, then it's just a matter of time, and sure enough, in 2015, the criminal clauses came back. So you're basically back to a very repressive set of capital controls. I want to tell a story from Maggie Thatcher. When Maggie Thatcher opened up the current account and the capital account in Britain, there was a discussion around reporting requirements. So some people said that, look, we'll free up everything, but people should submit some data to us, no? And the reformers said, where you keep the reporting environment, it is very easy tomorrow to just shut the gate tomorrow, that you will be able to bring back controls, because you're saying to people, you have to be orderly, stand in a queue, submit the form to me, and then you have a automatic access to a green line. But the point is to destroy the green line. The point is to get out of all controls. And so in the early 80s, when Britain graduated to full freedom, they removed reporting requirements so that in the future, no lefty will be able to bring back the capital controls. That's a scale on which this stuff needs to be thought. In the case of the Indian story. In 1993, again, the economists did a lot of hoo-ha, where they claimed that India has now achieved current account convertibility. So convertibility on the current account, where for import and export, all currency transactions are completely free. Okay, and this is just the delusion of economists who don't know law and public administration. I was like that. Okay, so in 1993, when these announcements came, I was like, yeah, this is so great. India is growing up as a country. We are moving forward. And I didn't understand implementation. Many years later, I started reading the damn laws. And the quick answer is you do not have convertibility of the current account in India. And we just have these delusions and completely wrong ideas. Our friend Bhargavi Zaveri and I have written an article on this subject. And when you go read the rules and the laws carefully, you realize that actually there is no convertibility on the current account in India. It's just a completely repressive system where all kinds of cross-border activities are blocked. Now, de facto, a good deal of equity capital does move, either as FDI, which is basically private equity, or as portfolio investments. And the Indian rich are able to take money out of the country. You and I would find it unbearably cumbersome. So net, what has happened is that if you're able to afford the lawyers and the accountants, you're able to get a fair amount of openness on the capital account. Our friends Nidhi Agarwal and Rajeshwari Sengupta have written 2-3 papers where they demonstrate that over the years, the de facto convertibility has gone up. And their recent Open Economies Review paper says that the de facto convertibility in India is actually superior to that in China. Okay, very interesting material. But you have thousands and thousands of lawyers and accountants making this work for the rich, and for everybody else, it's not available. So this is just the worst possible outcome. That do you think you're going to get some gains in terms of monetary policy? I'll come to that in a moment. The answer is no, you don't get those gains. Do you think you're actually going to close down the economy? No, you're not. I mentioned the work of Nidhi Agarwal and Rajeshwari Sengupta and others who demonstrate that over the years, de facto openness is going up, and in fact, India is more open than China. What are you getting? You're getting an employment guarantee scheme for lawyers, accountants, civil servants, and you're choking off everybody in India who's not rich. How is this a good arrangement?
This is a classic illustration of how the lack of freedom always hurts the poor first. The rich will find their way past it and they'll find a way to game the system. It hurts the poor. My favorite Maggie Thatcher story is that, at her first cabinet meeting, she threw down a copy of Hayek's The Constitution of Liberty on the table and said, "This is what we believe in." And a great lady demonized unfairly by the left, but I think just one of the towering figures of the 20th century and a great hero of mine. And, one thing you almost did today, which you did in the Seen and the Unseen episode of ours, is in that episode you gave away my freaking address. Luckily, it wasn't live. Our good editor Gaurav Chintamani cut it out. I told him, please cut it out.
Today I remember.
Yeah. Today you didn't give the address, but you did say a tower in Warsaw. So on the
There are
screen,
50,000 towers in
on the
Warsaw.
screen for you right now is a precise tower where I live. So Ajay, one of your great achievements, your and Susan's great achievements, is bankruptcy, by which I don't mean that you guys went bankrupt. But, one of the policies that you guys kind of pioneered and worked on for a long time was an actual bankruptcy code. We've spoken about it at length in our Seen Unseen episode as well. But for the sake of making this a complete account as well, tell me a little bit about, how that evolved and
So here's a strategic sketch of this field. Bankruptcy is fundamental to capitalism. Okay, capitalism without failure is socialism for the rich. So you've got to have firms failing. You've got to have financial firms failing. You've got to have banks failing. If you're not doing that, you don't have enough competition. Okay, so there's just no question that the entire dream, the Schumpeterian energy of the market economy, is predicated on bankruptcy. Now, you can do it nicely or you can do it badly. When you do it badly, there is just freewheeling chaos and there is a great level of uncertainty in the dying days of a firm. It is pure power play. The person with the most gundas grabs assets. Okay, and because everybody is in that free attempt of trying to grab some money or the other from a failing firm, it eats disproportionate mental bandwidth of everybody in the economy. What you want is predictable institutions. So this is like a Williamson North conception of institutions, that you create a script You create a well-established procedure. All of us sign on to the procedure. Large parts of this can even be done in a purely voluntary way without needing to be encoded by laws and the government. This is like my Bombay Stock Exchange story. We are all overdoing the role of the state in these things. But it's good that we will evolve institutions which become predictable scripts. Here is the magic pair of ideas at the level of economics in the field of bankruptcy. The first is that when a firm fails, the loss has already taken place. Now, all we are arguing about is who bears the loss. So, that is not the time for recrimination of who caused the loss. That's sunk cost fallacy. It's over. The firm has failed. And the only thing we are arguing about is the allocation of loss. So, the various stakeholders of the firm, the shareholders, the bondholders, etc., are fighting about who gets the carcass of the firm. So, imagine there's a firm with 100 rupees of equity and debt, and it has failed and it is now worth 40. So, 60 is gone. We are arguing about who gets the 40. And you don't want raw power play to control that 40, because then all 100 are fighting to grab their share of the 40. But rather you want a predictable institutional mechanism about how that 40 will be allocated. So this is the first key idea, that it's all over but the crying. All that's left is who gets allocated the loss. That's not a time for recrimination about the loss or to try to reverse the loss or to undo the loss. Sorry, it's over. The firm is gone. Now we're only here to think about who gets the loss. The second huge idea in this is that a firm in distress is a melting ice cube. Okay, it's just a fundamental feature of a firm that when a firm works, it's healthy, there's cash flow, day by day, things are getting done. Once a firm starts sliding into distress and it's starting to get difficulties on making payments, it doesn't pay a raw material vendor, it doesn't pay for the maintenance of its machines, it doesn't pay salaries. At this point, the firm starts falling apart because various pieces of the firm start walking away, and the ability of the firm to sustain itself as a productive organization rapidly vanishes. Now, every firm contains organizational capital. There are people, they know how to talk to each other. There are manuals, there is tacit knowledge, there is knowledge that is embedded, intangible knowledge in the working of the firm. A mere destruction of the firm can be wasteful. It has to be done sometimes, but it can be wasteful because actually there is a body of invisible capital that has been created in the firm. So you want to recognize that speed is of essence because a firm going into death is a melting ice cube. You want to work at the highest possible speed, finish the bankruptcy process, and ideally somebody will have come along to buy the firm as a going concern, and this moves swiftly enough so that the firm is protected as a going concern because the overall capital stock of the economy is not shattered. Then the firm stands. The people continue to know each other, work together, have process manuals, have machines, and the firm continues to produce. And the greatest example of this nature is what happened in the European telecom world after the 2G auctions. Everybody was over optimistic about the 2G auctions. They bid ridiculous sums of money to get those spectrum licenses. Okay. In the event, there was no revenue in 2G telephony, which is a metaphor for all telephony. There's no great business there. So all those firms went bankrupt. But nothing changed for the firms or the consumer. So you and I would have a mobile phone in France or Germany or wherever, and our phones continue to work. Our phone numbers stayed. We never got a missed call. We never got a dropped call. Somewhere up there in the financial superstructure of the society, the bankruptcy process played out. And the old shareholders, the old bondholders took a hit. All the losses were placed on the old shareholders, the old bondholders. Some new shareholders came on the scene and they picked up these firms as a going concern. The firm never collapsed. That's the dream of bankruptcy, that some firms are worthy of rescuing. Some firms, it's too late. Mostly in India, it's too late because of the passage of time. So in the future, I would argue that probably 80%, 90% of firms, if you can sense the distress early enough and you can initiate the bankruptcy process, then they are worth saving as organizational capital. In India, because the years go by, you've actually destroyed the firm, then the only decent thing to do is a burial. And these are the ideas of the bankruptcy process. So now to narrate the Indian story, there was no meaningful capability around the bankruptcy process. I remember in the late 90s, once Deepak Parekh, the head of HDFC, told me that in the entire history of HDFC, they have never repossessed a house. So can you imagine? HDFC was the biggest home loan company of India, And in the entire history of HDFC, they had never repossessed a house. So that's how it worked. In Yashwant Sinha's time, a law was drafted which is called Sarfaisi. This is the law that says that if a borrower has pledged a physical asset or a financial asset and they fail to repay, then the lender has the ability to come and grab the collateral. Okay, that's it. You may think it's trivial. What is the meaning of collateralized lending if not backed by the power by a lender to come and grab the asset? But that was not there. So that is Sarfaisi 2002. Okay, and then the next milestone in the story of bankruptcy is FSLRC. In FSLRC, there was a clarity on articulation that you need one kind of resolution mechanism for some financial firms, and then you need a normal bankruptcy code for everything else. What are some financial firms? Think like a bank where there are millions of depositors, or an insurance company where there are millions of policyholders. For them, they can't negotiate together in a room and figure out the end game of a firm. So there is a more statist approach which is called the resolution corporation. For everything else, you want a normal bankruptcy code. After FSLRC drafted the law for this resolution corporation. And after FSLRC finished, I think you've heard KP Krishnan tell this story. He took a section of the budget speech of 2015 to Arun Jaitley and said that why don't we blow this up and turn it into a full bankruptcy code? And that is how T.K. Vishwanathan led the Bankruptcy Legislative Reforms Commission, BLRC, a la FSLRC, which drafted the bankruptcy law, the Insolvency and Bankruptcy Code. Susan and I were both members of this, and Susan led the team that drafted the law. That's been lukewarm to a significant extent because of the way in which RBI has chosen to walk out of the bankruptcy process. So RBI more or less pushes banks that don't go do the bankruptcy code, keep it hidden, keep it under the wraps, do your own restructuring, but we will not participate in the bankruptcy code. And there are many implementation failures at the Ministry of Company Affairs, at the IBBI, at the NCLT. So once again, the usual Indian state capability story, the breakdown of knowledge and community. There was a recognizable bankruptcy reforms community. It more or less dispersed after the law was passed, and then things did not work so well.
I have a great episode on Bhargavi Zaveri, who was one of the people who worked on the code, where we talk about the history of bankruptcy also a little bit. That's a good episode. And I'll give a mid-episode recommendation here. Have you heard of a book called The Hollow Man by John Dixon Carr?
No, I don't know this.
So The Hollow Man by John Dixon Carr is a 1935 crime novel which was voted, I think in 1981, as the greatest locked room murder mystery of all time. Now, a locked room murder mystery is a particular genre where there's a dead body in a room that is locked from inside and there's no way in or out. And the mystery is, how did the dead body die? Or rather, how did the dead body become dead? Or, I'm not saying this well, rather, how did the person become a dead body, as it were, right? And The Hollow Man is a masterpiece because in the course of this particular mystery, all other solutions of all other locked room mysteries are kind of revealed. And one of them, a classic, almost cliched solution of a locked room mystery is a melting ice cube. So, a melting ice cube, which is a solution there, is actually a problem here.
Okay. While on literary references, everybody in the field of bankruptcy quotes Hemingway. Okay, so I think in The Sun Also Rises, there is a quote, person one asks person two, how did you go bankrupt? The guy says, slowly at first and then suddenly. And that is a brilliant description of what happens in bankruptcy.
There's another Hemingway story which you must have read, where there is a lion and the lion really badly wants to have a Hindu trader sandwich, which I think is a lovely formulation indeed. So Ajay, the next chapter might feel kind of redundant because we've covered this territory before. We have a great episode on inflation targeting. But give me a broad sense of the history of monetary policy and how people have thought over it across time.
Monetary policy in the deep old Indian history is incredibly interesting and fascinating. I want to show you a quote. This is from Oscar Wilde, from The Importance of Being Earnest, which was first performed in 1895. Miss Prism says, Cecily, you will read your political economy in my absence. The chapter on the fall of the rupee you may omit. It is somewhat too sensational. even these metallic problems have their melodramatic side. Okay, so can you imagine Indian monetary policy was making its way into Oscar Wilde in 1895. So there's a interesting and deep history of this. By the time we got to independence, monetary policy became a little mediocre. It became a simple world of fiscal dominance, that the union government would run whatever deficit it wanted and the RBI would print money to fund that deficit. So the deficit became the dominant story around the conduct.
For lay readers, please explain what do you mean by monetary policy?
Monetary policy is defined as the control of the short-term interest rate, and its flip side is the magnitude of the amount of money in the country.
So basically, the control of money supply indirectly or
Control of
directly.
money supply, either directly or indirectly, and they are intimately interconnected. You change the money supply, the interest rate changes. So if you increase the money supply, the interest rate goes down. In modern jargon, we always focus on the interest rate, but you could equally think in terms of the money supply as well. So in post-independence India, we increasingly crept into a period of fiscal dominance, where the dominant issue on the determination of monetary policy was to print rupees in order to fund the fiscal deficit. And that didn't work very well. We got a great inflation in the 70s. This is the inflation that happened in the period leading up to the emergency. And through the entire 80s, price stability was not so great. And in the early 90s, on one hand, there was a great piece of progress. There's something called the Ways and Means Agreement, where the Ministry of Finance and the RBI signed a contract saying that the automatic monetization of deficits will come to an end. But just around that same time, we jumped to another kind of dominance, which is where RBI turned into an exchange rate targeting central bank with increasing openness on the capital account. And that turned into a new kind of exchange rate dominance, that decisions to raise rates and drop rates were basically being determined by the currency objectives of RBI. So RBI lost one kind of constraint of fiscal dominance and walked into another kind of constraint, which was exchange rate dominance. And only now, at the end of the journey, starting 2015, we got to the first modern conception of a central bank, which is inflation targeting. And even here, it's a little concerning that in some ways RBI has come back to a lot of exchange rate management, more capital controls, and many people in the left are back to trying to snipe at inflation targeting. So absent the knowledge and the community, maybe this could become another reversal of reforms, as has happened for so many other things.
And the story of inflation targeting is actually really inspiring also in terms of how policy change happens. It might take a few years, but eventually it gets done. And it's a far-reaching reform. I'd urge gentle readers to check out our episode on inflation targeting. Sounds boring, inflation targeting, but it's super exciting. Movies will be made on this one day, so watch it. So, Ajay, across many episodes, we have spoken about firms, we have spoken about finance, we have spoken about firms leading finance. But as you know, I like to zoom in on the individual. So, tell me a little bit about personal finance, household finance. What has been the evolution of that? It's one thing that you have a business, I can go to a bank, that process can play itself out. But householder, want, personal finance for whatever reason. How does that ecosystem work?
I said earlier that the socialist conception of finance is basically for the top decile of the society, and those bureaucracies of centrally planned firms were not going to reach out and go to a larger number of customers. Personal finance, as in household finance, is really one of the good successes of India, and in my opinion, there are two key pieces of that story. The first of them was the creation of credit bureaus. Earlier, there was always a concern that an individual will borrow, but then they'll renege, they'll default, and who's going to send a collection effort after small loans? So basically, people are scot-free, they keep on defaulting. So formal financial firms don't want to deal with individuals doing small borrowings. Then you go to your money lender and deal with all those consequences. The credit bureau was a huge step forward, where the firms are able to keep track of each individual and put a black mark on the credit history of the person when there is a credit default. And that materially changed the incentives of individuals and really reshaped the world of borrowing by households in India on a large scale. So this is a great success where a new information organization, namely credit bureaus, came into place. And as an aside, it started out as a competitive industry. Then some really odd things have happened, and the nature of that industry is making no sense, and that's something we should be debating separately, sort of connected to digital public goods. Because in the central planning instinct, you actually don't want rival competing private firms. You want to control everything. So there's a whole bunch of things that came about as a central planning, with just very poor ideas, very poor knowledge, and that's going to be a problem in the world of credit bureaus. The second big piece are the NBFCs. The NBFCs are firms who fund themselves using bond issuance and do direct credit to households, and these are almost entirely private. There are a few government NBFCs. This is primarily a private space. There's been a good deal of private equity financing for the growth of the NBFC sector. So these are two successful pieces that in this entire landscape of a malfunctioning Indian financial system, this is one piece that has worked out reasonably well. There is an explosion of credit access for households all over the country. And then I want to tell a story that a while ago there was some big show organized by the Indian Express, and I was in the audience, and people like KV Kamath and Mukesh Ambani were on the stage. So I think Kamath asked Mukesh Ambani, or I think Shekhar Gupta asked Mukesh Ambani, what's your experience through the reform years and what do you see happened? And Mukesh Ambani said that in the bad old days, when my driver wanted a loan, they would come to me because there was no other way for them to get a loan. And he says, the other day I went to watch a movie at Metro and some teenager plugged my sleeve and said, do you want a loan?
Amazing. So, so I have a question for you. In my conversations with Harshvardhan and Rajeshwari Shengupta, one of the sort of worries that they've pointed out, and I think Harsh spoke about it at length, is that consumer credit has exploded to the extent that he worries that it is unsustainable. Many people are just taking loans for every damn thing, from buying a phone to buying a toaster to whatever. And at some point, something's got to give, and it could be a catastrophe when that happens.
That is indeed a set of concerns about the here and now. About the last couple of years, the post-pandemic recovery has been significantly debt fueled at the household level. But I'll just classify that as a small glitch in a larger journey. That for the first time, there is ample household credit access for the households of India, and that's a cool achievement. In the field of household finance, there is one piece which has gone a little nonsensical. This is around the problems of money laundering and terrorist financing. See, these are loaded words. I am very uncomfortable to use these words because the very words are so structured. How can you be for terrorism? How can you be in favor of money laundering? It must be something bad. I don't know what it is, but it must be something really bad, right? So a whole machinery came up in India at the behest of the United States Treasury and supported and encouraged by the Indian bureaucracy, where there is an insane financial surveillance system where every transaction in the country is watched, is measured, is written down, and if you've suffered endless KYCs, then this is the consequence of that. So on one hand, while credit bureaus and private financial firms have created the opportunity for huge progress in India, at a practical level, it's a bit of a nightmare. That if you're a household in India, you're being yanked around every day, being dragged from one KYC to the other. And then once again, it becomes a rich person's thing, that rich people have the staff and the assistants to cope with the entire compliance nonsense that is going on in India around this field. In the next couple of episodes, we are going to do one entirely on this know your customer, anti-money laundering, countering the financing of terror issues. But I just want to put that up as a fail in the field of household finance, that a lot of good expansion happened based on credit bureaus and NBFCs. And the opposing force that is limiting the ability of the average household in India to participate in formal finance is this whole nonsense of KYC.
So, Ajay, it's been a relatively recent phenomenon that the Indian financial system has actually got plugged into the global financial system. As you guys pointed out, when the 2008 crisis happened in the West, that was actually our first big test, because after we had gotten plugged into global systems, as the first time there's been a crisis, how do we deal with it? The story of how we dealt with it is told superbly in my episode with KP Krishnan and in various conversations that we've had even on this show. I can't remember the specific episodes. But tell me a little bit more about how do we think about this, because at one level the story you've told of Indian finance is a story of Indian finance, but at another level, at one point you could treat the story as a separate story on its own. But today, in an intellect world where everything is linked to everything else, everything is everything, we can't quite do that. So tell me about how the thinking around this has evolved.
So you are right to start at a focus on global crises, and there was an Asian crisis in '97. There was an LTCM crisis in 1998. There was the famous global crisis in 2008, and so on. And in an increasingly globalized world, we should wonder, is the financial system resilient to shocks? And around these global shocks, a whole body of knowledge and literature has developed around the word systemic risk. And let me quickly define it. If one firm fails, that's okay, that's normal. We use the word systemic crisis to describe the disruption of the working of the financial system in some parts where it impairs the working of the real sector. So it should not just be the failure of one firm, but it should be something bigger, where an entire chunk of the financial system gets derailed to the point where it has consequences for real people and the real economy. At this point, it is called systemic risk. And all of us, we started reading and thinking exactly the way you described, which is around global crisis. My views have shifted on this, and I've started understanding that even without any global shocks, there is plenty problems in the Indian financial system, and the Indian financial system is entirely capable of generating a systemic crisis all on its own, because there are so many failures around regulation, around resolution, around monetary policy. So roughly this is the complexity, that we mishandle monetary policy. So the central bank is pouring LSD in the punch when the party gets going, and we fail on prudential regulation. So the firms build up crazy levels of risk, and when the firms get into trouble, we don't have a resolution mechanism to shut them down. And these three things interact with each other. Okay, so systemic crises are all born of this interplay of a monetary policy that is not doing inflation targeting, of prudential regulation that is not doing the right things. As an example, I showed you the way to think about banking regulation, and of a failure of resolution, that we don't have the ability to close down failed financial firms. So when you start thinking about India in these ways, we realize that there are crises happening all the time. In 2010, Andhra Pradesh banned microfinance, and the entire Indian microfinance industry had a crisis. The whole sector got disrupted, and that, in my book, is systemic risk. Okay, so in similar fashion, in the paper from 1992 to 2018, I show 6 systemic crises, which is really a lot. Every few years, one next crisis comes along. And then with the COVID lockdowns, we had a great wave of trouble all over the country. Many financial firms had a problem where people were not repaying their loans and so on. So I would just like to alert everybody that systemic crisis is not a global Lehman crisis or a global LTCM crisis. It is those, but it is also failures here in India, and every now and then a part of the Indian financial system collapses. And this is again part of the journey, that at present the Indian financial system fails on all the goals of growth, inclusion and stability. And that's the game that we need to get on, the 25-year journey of solving all these things.
Do we have a clear conceptual understanding of all of this? Because sometimes when I read about this field, I feel that people are kind of wading through waters where they don't really know what's going on fully. What's your sense?
So I feel that at every point in time, we are pretty good at fighting the last war. And you know what? That's great. So the last war covers a great deal of knowledge and sophistication. And then it is in the nature of finance to innovate and build new things, as they should, because the world is not fixed and technology changes, the world changes, and we need to invent new kinds of business models and new kinds of products. And then it is in the nature of government bureaucracies that they will always fumble and fail on understanding the changing world. So you remember when Mohit and you and I spoke about Silicon Valley Bank. In hindsight, it appears obvious that once you have an electronic payment system, all the money in a bank can flee over a weekend when actually the bank is closed. That was new. In a way, we'd never thought about it. So it was a new technological context that created a new kind of run on the bank, the likes of which had not been seen in the last 500 years. And so you have to change, you have to adapt. And it is not easy for any government bureaucracy to keep up with these changes. So my realistic worldview around finance is that a modern, sophisticated, capable financial system is of essence in the journey of development. I'm not a lefty. I do not resent finance. I do not resent the presence of rich people in finance. I do not resent the presence of some of the smartest people in finance. It is not a misallocation when a person will work in a financial firm instead of doing particle physics. Finance is the brain of the economy. You want the best people to be in finance because finance shapes everything else. Wall Street tells Main Street what to do. You want your best brain power in finance. And they will innovate, they will figure out the world, they will do new things. And it is difficult for the bureaucracies to keep up. So you will keep having difficulties and crashes, and we should grin and bear it. It is a part of life. So we should try to be as good as we can. But given public choice theory, there is no perfect government bureaucracy in the world. So we have to cultivate the knowledge and the communities through which we will keep these fields honest and we will do well. And after that, we have to accept a certain incidence of crisis as a normal part of the world.
I'm glad you mentioned public choice theory. Please do check out our excellent episode on it. You know, I have full faith in finance in innovating, solving problems, forging a path ahead. I also have full faith in the ability of the state to pour LSD into punch, as you put it. You know, we often, in the common imagination, 2008, that crisis is spoken of as if it is a failure of markets. But actually, you know, Larry White has a great essay on it. We'll link in the show notes. Arnold Kling has a book on it. Most of it was state overreach. Frankly, the state went too far. And I know that we can, you know, disagree about solutions, but what was touted then is there is systemic risk, and therefore we have to, you know, bail out the companies we have to bail out, and the state did that. And I know you're a great admirer of Bernanke and the guys who took part in that. And what I worried about at the time, and a question I often ask, is about the moral hazard, right? That essentially what you were doing then is that you were privatizing profits but socializing risk, saying that if as long as the banks are making money, they can make the profits, that's great. But the moment they fail, the state will step in and the poor taxpayer will have to pay, which you and I agree is not the way market should work. If somebody fails, let them fail, which creates a dilemma of, was there really systemic risk? I've heard different answers. I know you believe there was, but I've heard contrary tales. But this overall picture is what kind of worries me, because the state will always kind of step in a reactive way and end up making things worse in the next crisis.
So I agree with everything you're saying, but I just want to be very careful in articulating what I think is a fair position. We've got to understand that we are a very poor third world country, and finance is of essence in the Indian growth journey. So if you care about growth in India, you got to care about finance in India. Finance is the brain of the
No,
economy.
no, I'm not arguing with that.
Wait, one minute, okay? So we've got to play for a modern, complex financial system. And many socialists don't want that. Many socialists would like to just ban everything. Okay, so you get a central planning system, you get the silence of a graveyard. It has all kinds of harmful effects for the growth process, but that's invisible to the officials who are banning everything. They get their peace of mind. Okay, so first we've got to go there. Then part B, I don't want to say that with sufficiently clever people, we will get the state intervention right. So my theory of the next 100 years is we will always fumble, we will always fail. It is not possible for government agencies to get this right. And that's just part of the bargain. It's sort of like natural disasters happen. Financial crises will happen. It's the way of the universe. It's a part of like a Lucas critique that once you establish a set of rules, very clever people will apply their minds on how to generate a somewhat higher ROE in the light of those rules. And the government can never keep up because officials are always fundamentally weak and lack incentive to figure out what is going on in the financial system. So the government will always be 3 moves behind and things will turn into a mess. So I'm not excoriating the officials because it is in the nature of the state. You're a state organization. You can't aspire to capability. You can't aspire to competence. The best intellectuals will always know more than the government organizations, and they will often have a good clue of what's going on in the world. But we don't know how to build a government that is able to bring the best knowledge of the country on board into the formulation of public policy. So we should understand and accept the bargain that you get a great financial system and it will give you periodic woes as you go for the next 100 years. And what we need is a far more forgiving discourse around us, that the way the lefties jump and attack finance, financialization, and the implicit socialism of government bailouts, I feel is not a fair cost benefit analysis, because yes, while you're putting down public money, sometimes you're also getting your entire GDP out of it. You're getting your GDP growth out of it. And there's a certain populist hatred of rich and successful people that is clouding our minds.
I'm making the opposite point. You see, Ajay Shah, to me, you are a lefty. Because while I agree with you on the first part of what you said, that finance must thrive, finance is essential, we must never get in their way. I have an issue with the second part because I feel that all the mistakes are made by the state. Like you correctly said, public choice theory explains it. It's a structure and incentives in play, not the individuals. And therefore, my solution is that we must severely constrict the power of the state. And I know you will disagree with this, the state should never bail anyone out, period. So all this talk of systemic risk, if there is systemic risk, let the freaking system fail so the next time it doesn't happen. If you continue creating moral hazard by putting the money of poor taxpayers, it's essentially a tax on the poor every time you bail out a bank. And that to me is both morally and practically wrong.
Amit Varma, you are a man after my own heart. A couple of years ago, I wrote a project proposal with the following title. And in a way, you can see how much of what you said fits in that title. The title is Financial Regulation as if State Capacity Mattered. Okay? So take seriously the failures of the state. Now what will you do? And in many, many things, the correct answer is to let go. In many, many things, the correct answer is to take moral hazard seriously and change your behavior, but not be the optimistic younger Ajay Shah who believed that you could create better bureaucracies.
Ajay Shah, once upon a time you were the young Turk of finance. Now you're just a middle-aged Indian sitting on a lawn.
Now I'm just a YouTuber.
Now you're just a YouTuber, even worse. So tell me, what have you learned in the journey, through working in finance all of these years? What significant matters have you changed your mind on?
So when I started out, I was an economist. Okay, like foolish things like because some press release says current account convertibility, it is done. And I used to think that the really important questions are at the level of, do you want inflation targeting or not? Yes, all that is very important. I don't wish to denigrate that. It is very important to get your strategy right, that what is the nature of the financial system that we are building. But then what I have learned is that there is a great devil in the detail, in the implementation, and the implementation is the land of public choice theory, state capability, rule of law, checks and balances. And so my journey in learning finance in India has been the journey of understanding the problems of state power, the problems of arbitrary power that are placed inside the Indian financial agencies. All over the world, financial regulators are special in that they pierce the separation of powers. Okay, so gentle reader, from the 17th century, there is a constitutional principle in all liberal democracies that the state should be cut up vertically into a legislature which makes laws, an executive that enforces laws, and a judiciary that awards punishments. Okay, so the legislature should define the IPC, the executive should do the investigation of a crime, and a judge and only a judge can award a sentence. Okay, do not concentrate these powers, because concentration of power is a dangerous thing. Very well, regulators concentrate these powers. All over the world, regulators combine the legislative power of writing law and the executive power of enforcing the law. So now already you're in trouble, that you have fused two branches of the state, and that is an high concentration of power. In India, something even more remarkable has happened. The only country in the world where even the judicial power has been fused into regulators, even though this is violative of the basic structure of the Constitution of India. So, this is something waiting to be exploded through suitable litigation at the Supreme Court. But the consequence of that has been agencies in India have immense power. They write the rules, they enforce the rules, they pass rulings on whether the rule was violated. And you say, I think that's what you said in the sentence. They say, no, but I wrote the sentence. I understand the sentence better than you. So you're literally in a lawless land where the agencies control everything. And now we've got this juxtaposition of central planning and non rule of law. And this has exerted immense consequences. For one thing, it has created a climate of fear that nobody is willing to talk openly and criticize what regulators and financial agencies do. So that's just very harmful, because if we will not honestly analyze our problems and criticize them, then how will we get on a path to progress? So this is the big insight on what is going wrong with the financial agencies of India.
You know, in all my years of writing about free speech, one of the terms I keep using is the chilling effect, which is you go after one guy and you lock him up for saying something you don't want. Other people shut up just because it has that chilling effect. Similarly, in finance, I can very easily see that there can be a chilling effect by the overreach of these agencies, where it can dampen investment. And when you dampen investment, you dampen jobs, you stop prosperity, the poor stay poor, and etc. etc. It just plays itself out in all of these unseen ways that we don't see. And it is really no secret that these investigative agencies can be used by the forces in power to, put their political agenda across. And we both know like tragic examples of that. So,
And
yeah.
also the central planning system. The power of a central planning system is that the words change a little bit here and there, and they make and break businesses, and all businesses know that. So now the businesses are quaking in their relationship to the agencies. They are obsequious, they will always be deferential, they will never criticize anything in public. So in public, the agencies lord over the society. It is the combination of central planning and lack of rule of law.
Ajay, you've given me a fair idea of the destination. Tell me about the journey. What were the processes that got us here? Like, what happens in the policy process? You know, who are the players involved? What are their incentives? How has all of that played out?
Uh, while I'm on that, I just want to point you, gentle reader, to table 2 in the paper, which is a 1-page chronology of Indian finance. And everybody loves that. So, all kinds of people have said to me that that is truly great, because for the first time across all the sectors of Indian finance, there's one unified chronology of the big milestones. Okay, so what is the process that worked and what is the process that didn't work? This is basically straight out of our EIE episode on the long road to change. Okay, so it's a journey of data, of research, of an intellectual community, of community building of people that cared about these things and thought about these things, that argued with each other in blog articles and op-eds and seminars and conferences, of lively, vibrant disagreement and debate on these questions. And as I said, the most important partnership was where the Ministry of Finance and SEBI and NSE and a bunch of academic organizations were the main engine of the thinking and the doing of Indian finance. So that is my template, and we've lost all that. So now in the next 25 years, that's the story of how to recreate that.
So Ajay, when we speak about finance, when we speak about credit, it is not just at the conceptual level that it is important, but it is also about how much friction we can reduce in the system, how easy can we make transactions, how we can lower transaction costs, and so on. Now we've had an episode on what is allegedly called digital public infrastructure about this, where we've spoken about the pros and cons, what's good about it, what's not so great about it. But overall, where do you think that this fits in your story about the journey of Indian finance?
I think of finance as being fundamentally around questions of risk and time. Risk, that we all take risky bets as our projects, and we form risky portfolios. Okay, that's the heart and soul of finance. And time, that I'm taking some actions today, and there will be a bond that pays off in 10 years, there will be an option that matures in 10 days, and so on. So moving cash flows across time and taking risk. This is the heart and soul of finance. Information processing is the heart and soul of finance. Now, layered on top of that, there are lots of processing efficiencies. So, the same Rangarajan committee report that chose an SMD disk controller for Uniplus Unix machines with Motorola 68K processors, which went into every bank in India, created operational efficiencies of having computerization. But that's not central to this. So, I am a great enthusiast of the computer revolution, but that's a plumbing that, yeah, you need it, and everybody should have more computers and computerization, but it's not of essence. Finance is about information processing, it is about how Wall Street runs Main Street, it's about risk, it's about speculation, it's about movement of cash across time. And so I take for granted that, yeah, there'll be lots of processing improvement.
No, and in fact, I'm glad you mentioned the Rangarajan committee suggestion about which processor to use, because our core sort of protest against what DPI, DPG, whatever you call it, India's digital public infrastructure, is that you have exactly that same central planning mindset. Just as the Rangarajan committee said that you shall use this processor and no other, similarly we are stuck with one payment system and no other. Whereas ideally what we are saying is payment system are great, let's reduce friction, technology is awesome, but let people compete. And you're really crowding out future competition and future innovation just because you've come out with a product that is damn good right now. But if you look at the structure and the incentives, it's a problem. So Ajay, sum it up for me. On the one hand, India's come a long way. We are more globalized than we were. We are in certain ways freer than we were, certainly freer than we were before 1991. I think in the last 10 years, last 15 years, some things have gone backwards. But, net, what is your story? What gives you hope? What gives you despair?
Some pieces are good. So until a couple of years ago, the equity market was a shining star. Similarly, I described credit bureaus, NBFCs, this stuff has worked well. But in the main, I remain nervous that it is mainly a central planning system. The agencies control the products and processes, and they have all kinds of entry barriers. Private and foreign is kept out in many, many things. And so, we haven't graduated a whole lot. I think a lot about isomorphic mimicry. So we have something that looks like a bond market. There are some screens, and you can show a gullible foreign visitor that, oh, we have a bond market, we have a clearing corporation, we have a depository, and things that are vaguely like a bond market are there. But actually, the heart and soul of a financial market, namely open entry to trading and speculation and derivatives trading, is not there. So what is there is just one big show of market-like structure, but effectively the officials will tell you what every interest rate is. So it's not that much of a market. So again and again, all through Indian finance, we have isomorphic mimicry. Just because there is a building which carries a sign on it that says central bank or securities regulator or insurance regulator, it doesn't make it the internal capabilities of a central bank or a securities regulator or a or an insurance regulator. So I feel we've got to be far more careful and skeptical about how state power is rolled out, and much less has been done in terms of scaling back the central planning system than meets the eye. So roughly speaking, I would put down 3 phases. Like, there was an old phase of very explicit socialism and public sector domination, roughly 1947 to 1991. Then from 1991 to perhaps 2016 is a period where on one hand there was an emergence of knowledge and community and some things got done, but also a lot of fake stuff. Like, you call it current account convertibility, but it's actually not there. Okay, you call it a bond market, but actually it's not a bond market. Okay, like that. So many things were kind of exuberantly named, and there was not enough honesty in saying that, this is not it. I mean, this can't be called a bond market. This is not called current account convertibility. And then we are at a phase 3 where, we're just muddling and lost. And I feel now our journey is to put Indian economic growth foremost, and finance is a central part of the country's growth journey. And we have to organize ourselves for a 25-year journey of building knowledge and building community.
You spoke of isomorphic mimicry. I have a TikTok video that illustrates exactly this.
ये थोड़ा आराम चलाओ, ज़्यादा तेज चलाने की ज़रूरत नहीं है। बस।
For those of our gentle readers who don't know what isomorphic mimicry is, in the policy context, it basically means you take a policy that has worked somewhere in Britain or US or Sweden or wherever, you bring it to India and you assume it will work. And of course, most of the time it won't work at all because the local conditions are completely different and you have to, adapt to those and cater to those. And I have Shruti Rajgopalan and Alex Tabarrok wrote a great paper on this, and I have an episode with them as well, elite imitation in public policy. So a lot of insights there.
Amit Bhai, give us a recommendation today.
So, there used to be this man greatly respected by all as an economist till he turned a YouTuber and started doing content. His name is Ajay Shah. It's you, Ajay Shah. And I want to recommend your paper, The Journey of Indian Finance. I learned a lot from it. And this episode is great as a sort of a condensed recap of what all is in there. But, gentle reader, if you care about the subject, read the full paper. Tons of knowledge. And it's really the definitive, work on the subject. As it was, so worth reading. What's your recommendation?
I have two recommendations. The first is the edited book, which was the trigger for writing this paper. So you've already supplied the name, the Cambridge Economic History of Modern South Asia. I have seen the table of contents. It is droll. So I have not yet got the book. The book has not yet been released, but it's just like the best people have been brought together. It will be a gorgeous book. And the second is I want to tell you about a lovely book in finance. It's called Capital Ideas by Peter Bernstein. It's about the emergence of the early ideas on finance. It's just great fun.